Okay, before I get started, I'm not a licensed insurance agent. I'm not a licensed financial advisor. I'm not giving you advice or selling you any products. I'm simply sharing with you my IUL design that I work with to get the most cash value, most planned premium into the cash value column before any credit interest from the index. So, regardless of the credit index rate of return, most of the premium gets into the cash value column, stays in the cash value column, and then at age 65, you get guaranteed income based on the cash value column. So, I, if I was an agent, this is how I would sell an IUL. And if the client didn't like it or the client didn't align with this IUL design, I would not sell it the IUL. Okay, you can't make an IUL fit every client's wants or budget. The client has to align with the IUL, and they're going to need to pay uh, above, significantly above the cost of expenses, cost of insurance expenses and fees. So I'm gonna show you how the best design that I've seen, the best design for cash value growth with guaranteed income for life looks. This is the best design that I've seen. So I've shared this with agents after I asked them for the best. So over the last 5 or 6 months, I've been developing this design. I got it together roughly, tweaked it a little bit to get to where it is today, but I shopped it around to multiple different agents who use multiple different carriers, and no one came close. No other agent, no matter their years in the industry, or no other carrier came close to being to this design. The cash value growth before any credit interest, the cash value amount before any credit interest was nothing close to this one. Okay, so the best design just so happens to be with this carrier. I'm not saying this carrier is the best. I'm just saying the best design just so happens to be with this carrier, and I will explain why. So keep these numbers in mind that if we're gonna do a monthly premium of $1,000 a month, I use the same profile. My wife, 35 years old, female, better health, same plan premium. I've asked 20 plus agents. Um, Before I designed this policy, I never seen it like this before, nothing close. I've seen hundreds of policy designs from probably 40, 50 agents. That's a lot. And no one came close. Um, I asked for the same plan premium amount, same age, and the good agents, or better than most agents, come back with something like solve for lowest face value max cash accumulation, and you'll get something like this, somewhere around 300,000 uh, death benefit or face value if you die tomorrow. That's about that's about what you'll see for a quote unquote good agent. You'll see better than most. Some agents say, "Oh, congratulations, you qualify for $1 million. You qualify for 800,000. You qualify for 700,000. You qualify for 600,000. You qualify for 500,000. I asked them for the best cash value growth design with guaranteed tax-free income for life, and they come back with $1 million death benefit. They don't know that I know better, but $1 million death benefit would mean that there's a huge gap between the plan premium and the death benefit. This right here is designed to guideline level premium, but when you raise that death benefit amount, you create a gap between the plan premium and the guideline level premium, which only serves to increase the agent's commission. So if you're a client and you have a smaller premium payment and a huge death benefit, and there's a gap and it's not designed to guideline level premium, you're hurting yourself. It's like you're falling on your own sword. So an agent will be like, yes, I'll sell you that policy. That sounds great. If that's what you need, awesome. You need $1 million in death benefits. You can only afford $1,000 a month. No problem. Congratulations. Or they'll say, well, let's qualify you for a little bit more than you need right now in case you want to increase it later. If we don't, well, you start off hurting yourself. These are not, IULs are not legacy death benefit products. When you try to create a legacy death benefit product using the IUL, you create that gap and you can't use it for income. You have to choose. If you want to pay $1 million worth of premium, so this would be like, double that for $1 million worth of premium, then you need to pay the guideline level premium and don't touch the cash value later in life. Don't try to take out income later in life. Just make the guideline level premiums until you die. Or make the guideline level premium and let the cash value pay for the policy later in life. But you don't take the cash value out. You don't take the surrender value out. You make the guideline level premium payments, and then you let the cash value pay for the policy later in life. So say you pay to age 60 and you have a ton of cash value in there. 60, you have $1 million of cash value in there. You can cut back or stop making planned premium payments or make smaller premium payments. Let the cash value carry the difference or pay the difference. But as far as taking out loans and income, no. You have to choose between the death benefit or the income. You can't have it both ways. You try to have it both ways, that creates a huge problem because there's a gap and you're not growing enough cash value. And then when the premiums go up, it's going to eat into that cash value. The premiums go up, eating the cash value, and you try to take out income. That's a recipe for disaster. Those are the policies that lapse. Those are the policies that people complain about or you talk about. So for all the IUL carriers out there who want to complain about IULs, they're not designed to guideline level premium. Either the client doesn't understand that and the agent, or the client doesn't understand that and the agent does, but the agent still writes the contract for the commission. Well, as a client, it's your responsibility to pay the guideline level premium. It's your responsibility to demand a policy designed to the guideline level premium and not let the agent create that gap. So we the clients have to do our part, have to be educated enough to demand the best policy and understand the limits of IULs. If you don't have a budget or plan premium that's like 80 to 91%, 80 to 91% above the cost of expenses, cost of insurance, expenses, and fees, you're doing yourself a disservice. Don't go to an agent with a small budget wanting a huge death benefit. You're setting yourself up for disaster that if the agent writes that contract, he's assisting you in that disaster and assisting himself in more commission. You need to be paying a premium, a planned premium of 80% or more above the cost of insurance expenses and fees. I figured out how to get it to where our planned premium is 91% above the cost of insurance expenses and fees, which is unheard of. Out of all the IUL, 100 plus IUL examples I've seen, illustrations I've seen, out of 40 or 50 agents, no one showed me this. No one showed me this. They stopped at 80%, maybe 85%. No one pushed it to 91% because it affects their commission. They did, at best, a better than most IUL design. They did not do the best IUL design for me, the client. Me as a client, I as a client had to come up with the best design because I care more about myself than the agent's commission. I had to deal with this policy 20 years from now. I have to make the plan premium. I have to worry about the allocations. No agent is going to be there 20 years from now helping me manage my policy or help me manage my policy until I die. So you got to understand that your policy contract is between you and the carrier. Regardless of who your agent is, you got to understand, you need to be able to understand this and manage this policy till the day you die. The best way to do that is with this design I'm about to show you, with a guaranteed lifetime income benefit rider that you turn on at age 65 and you no longer have to manage it. You don't want to be managing this at the age of 80. You don't want to be managing this at the age of 90 or 100. You don't want to have to depend on someone through a trust or whatever who doesn't fully understand what's going on to manage this policy. You want to get a policy that gets the most planned premium into the cash value column day one, keeps it in there throughout the funding years up until you turn on to, throughout the funding years and up until you turn on your lifetime income benefit rider. And then you're done managing the policy. So you live to age 65, you're still in your right mind, you turn on your LIBOR, and you're done. No more managing the policy, no more worrying about down years, no more worrying about what size loan can I take out. You turn on your LIBOR and you're done. Now, the best design just so happens to work with this carrier. I'm not saying it's the best carrier, but it just works out. It helps to facilitate the best design. So, let me hurry up before I run out of storage space on my video. Okay, let's go down to this page. This is the plan, the playbook, all right? This is the playbook. So, illustrated future policy actions. These actions, you have to call in to the carrier and execute these actions, but at least you have the plan on paper. A lot of carriers don't have this plan in the illustration or in the illustrated contract. This carrier does, which is great. So first you're gonna do it at age 60, year 27, is stop making premium payments. All right, you maxed it out. You made maximum payments to the guideline level premium to age 60, and then you're gonna wait and let it cook for 5 years. That's our plan. The year after you start making planned premiums, to avoid a MEC modified dominant contract, you're gonna wait some time, and you're going to go from Plan B to Plan A, from increasing the level. Increasing is very expensive. You want to level it off, and make it a lot cheaper, because this is not about the death benefit. This is about the cash value growth. So we're doing everything we can to get the most cash value into the cash value column, and then we're going to level off the increasing to level plan A, and then we're going to drop our APB. So the APB is, I don't know if you can see this or not on the camera. The APB is the difference of the face value. So remember that $300,000 number, 333,000. Well, it's a combination of the face amount and the APB. So National Life Group is the company that allows you to lower the APP the best. Lower the face value the best by splitting it with additional protection benefit. Other carriers come close, but not as low as National Life Group. So, before my wife had the medical exam, she was rated as preferred. So standard, preferred, elite. So preferred, we got it down to 91,000. All right. As elite, we got it down to 84,000. So you want to push this number down as much as mathematically allowed, and then you want to show the large amount with additional protection benefit. What this does, the agent does not get paid on the larger amount. They get paid on a smaller amount. That's why it works out so well, makes it so cheap. You went from 333,000 total, with the agent getting paid off of that larger amount, $2,000-$3,000, down to 84. That cuts the agent's commission down significantly. That means more of your plan premium gets into the cash value column. Let's show you that later. So these are a few of the triggers you're going to pull as a client. You're going to stop making the plan premium payments. You're going to go from plan B to plan A. You're going to drop the APB, and you're going to do a max death benefit reduction. You're going to lower that corridor, the 1/1000 corridor, down, because you're not going to make any more plan premiums. You don't need to make any more plan premium payments. You already max funding it, and you're going to reduce that death benefit down as low as possible, so it makes the cost, expenses, and fees even cheaper. I've seen it go from like 14,000 down to 7,000 later on in the policy. So around like age 80, it jumps up around age 90. So by doing these steps, you cut that cost in half later in the policy. But that doesn't even matter, because by age, well, it does matter, because they're going to calculate the LIBOR payments based on what the cost of insurance is. So since you're not taking loans out every year, this would greatly help that as well. But since you're taking out the LIBOR, and they're calculating the math based on the cost of insurance and everything, you want to give them, you want to make sure that you're paying the least amount of cost of insurance, business, and fees, so you have the best cash value growth up until the LIBOR cuts on. And when they do that mathematical equation, that they for the future, you're paying less. It increases your LIBOR payments as well. So as a client, demand this structure. As a client, understand you got to choose between death benefit or cash value and income. You can't have an IUL design with both, because that creates a gap. It creates a problem. It lowers the cash value growth. The premiums are going to go up in these policies, and you got to pay more premium later, or the policy could eat up your cash value growth. So with this policy design, the cash value grows. The cash value growth is better because more of your plan premium gets into the cash value column, and it's the best design because 91% of my wife's plan premium gets into the cash value column. Day one, it stays in there throughout the policy, and it grows the cash value the best so that you have the best tax-free income for life. All right, check my video. Okay, we're still recording. All right, so guideline level premium. When you set your planned premium payments, they should be the same as your guideline level premium. All right, so it's like $28. This is down to, so $20. I can pay that over the year, or pay that one time with the payment of $1,000. So 1 month we pay $1,028. That's how good this policy is designed. You wanted this guideline premium to be $12,000. You pay $12,000 a year. When you do the face value APB split, you may have it may be $12,002. You know what I'm saying? It's a little bit off. But it was $91,000. It was $12,700 something. So it's like extra $40, $6 a month payment. But I've seen it where this number is $24,000. Congratulations, you qualify for $1 million worth of death benefit, and then the guideline level premium is $24,000, but the plan premium is only $12,000. See that a huge gap? And then if you look down here, their commission will be like the target premium is the commission will be like $20,000. I'm like, well, why am I paying you $20,000 commission? That's not what I asked for. I didn't ask for you that. So if it's $300,000 and not the 84, that's like $3,000 commission. If it's $20,000, that's killing your cash value growth. Better than most IUL design, where these numbers are combined and it's not split, costs your policy like $30,000. It pays out a commission of like $3,000, which translates to a cost of like $30,000 cash value growth in your policy with like the first 10 years. So screw that. Don't fall for that. Go with this face value APB blend. Lower that commission down to $700 and get most of your cash value into the cash value column. And let's look at that, why that's so important. We're going to look at we're going to look at the guaranteed column of the illustration. All right. So let's go down. All right. See this guaranteed illustrated values. So in most IUL designs, as long as you make that plan premium, the guaranteed column without lapse. Oh, not say most, because some are, if it's not most, some are, when they design it to target, or when there's a big gap in the guideline level premium, it could lapse your guaranteed column. So I won't say most, but your guaranteed column, when you're making plan premiums, should not lapse. And then what happens is when people go to take out those loans, usually those loans lapse the guaranteed column. But however, with this design, there's income for life in the guaranteed column. So age 120. So all the other agents, all the other designs skip past the guaranteed column. If they don't worry about that, that's the worst case scenario. If that happens, we got bigger problems. No, I went to the guaranteed column and created a left limit. So now you got a wall there you put your back against. Worst case scenario, if it happens, not as a guarantee happen, But if it happens, you're guaranteed to get income. As long as you make your premium payments, you guarantee income in the guaranteed column. That's unheard of. That never happens in any other illustration. Out of the hundreds of illustrations I've seen, there's no there's no income to 120 years in the guaranteed column. This is the only time it happens. This design is the first and only time I've seen that. I never seen that until now. Or if it was income in this design, income in this column, it was like uh, very very small amounts, smaller than this. So uh, that's why this design is so important. You don't have to run from the guaranteed column. You can run to the guaranteed column and show the client you still have income to 180. Now, if you have income over here in a guaranteed column to age 120, that's a 2%, then the market's getting like 6 to 8% on average from the indexes currently, then chances are, not guaranteed, chances are you're going to do better than 2%. Historically, people have been getting 6 to 8% returns on average. So if you're getting guaranteed 2% with income, chances are you're going to do better than the 2%. All right. Let's go down to the alternate. Alternate and current, they kind of mix them in. They're going to separate the current later. So the non-guaranteed alternate is at 3%, and it has income as well, of course, until there's the income, 34,000 until age 120, of course. Bam, 120. As you can see, the current column has income as well. The current column always has income, so you know that's not okay. So this 6.22 is based on me splitting the allocations between S&P and their Credit Suisse. If I went with the Credit Suisse, it would have illustrated a 6.44, I think it went up to now. So I wanted to, in reality, the one we submitted to the carrier, I want to kind of mix it between half S&P and half uncapped, because I understand that every month you put premium into the allocated index, it's stuck there for a whole year. So I want to give myself a 50% chance of getting a good rate of return. So currently the S&P index I chose is getting 9%. Currently the uncapped is getting 9%. If one of those drops, I'll shift 100% of the money into the S&P or 100% into the one that's doing better. So say the uncapped goes down, but the S&P stays at 9%, then 100% will start going into the S&P. If the uncapped goes up, then I'm going to put 100% into the uncapped. So as a client, you have to be most responsible for allocation of your indexes. At the end of the day, it all falls on you as a client. So yeah, be very proactive. Learn as much as you can as a client, and reallocate when needed. Keep in mind the premium goes in there to the index, and if it's a 1 year point to point, it's stuck there for a whole year. So June 2024 to July 2025, that premium is stuck in the index. The index goes down, you don't get any growth. If it's not averaging 9%, it goes down to zero. It's stuck in that. You get a zero for that premium for that whole month for a whole year. So don't go with the default one that's getting you 0%. Make sure you ask the agent for the current uh, rate that the index is getting. That's what I had to do. I had to be very proactive in developing this design and very proactive in choosing the indexes. It's like I was almost the agent in this process, building it for myself. That's how. All thing I didn't do was type it into the computer. The agent did the typing, but I was like, hey, what about this? Try this. What about this? Do that. No, I don't like that. Do this. No, I don't like that. I don't like that index because the index is getting zero. Don't put my money in the index. And then the application one had me in the index getting zero right now. And then I made her rewrite it, resubmit it. This is a second and final design we submitted to the carrier. Rewrite it, submit it to the carrier because I didn't like the one that was the carrier was using. The carrier was using the application illustration, which had me in the index getting zero, and they tried to put the money in that index, the default one. I'm like, no, take the money out of that default one, put it in one that's getting a credit right now, and then we'll move it later accordingly. So you got to be aware of those types of things. Don't just go with any illustrated rate because it looks good on paper or historical data says it's getting 6.4. No, you want to know what the current rate is last month, month before, last year, that kind of stuff. If it got a zero last year, getting a zero now, don't put your money in there because it's stuck in there for a whole year. So why start off with a zero? We can start off with 9%. So if I put it all in the uncapped, this would show 6.44, and then the LIBOR payments would be even bigger. They'd be like 73,000. In reality, both the index we're using are getting 9%. So if this was 9%, then the LIBOR payments would be like 80,000 or more. But since it's only illustrating at a 6.22, then the LIBOR payments illustrate as like 65,000. So anybody who has a complaint about the LIBOR payments amount, keep in mind it's based on the 6.22 rate of return or instant credit rate, which is lower than the actual performance of the index right now. So it's better to be to under illustrate the performance and the LIBOR, and then be surprised with higher payments later, than showing a high credit interest rate. Like some carriers, some agents show a higher rate and higher loans, and then be disappointed. I don't want to be disappointed later. I want to be disappointed now and pleasantly surprised later. As an agent, we go back. As an agent, you can even reduce this down to 6%. So you can reduce it down to 6% or lower, and pitch it. Hey, I want to show you a 6%, so that when you in the future, when it performs better, you're happy with that. So you can lower this to 6%, and then it will lower the LIBOR payments. Just understand, hey, currently it's performing better. All right. So again, LIBOR payments 65,000 until age 120. So I hope you can see this clearly on the screen. I hope you can hear everything I said. This is the best design for cash value growth with guaranteed income for life. Let me go back to the current column. Hold on, let's see. Let's show you something real quick. All right, so year one, we're paying $12,000 of premium. Look at how much gets to the cash value column. $11,381. That's 91% of the plan premium. 91%. So before you even talk about crediting interest or rate of returns or indexes or allocations, 91% of the plan premium gets into the cash value column because we lowered the cost of insurance expenses and fees. Let's go to that. So I don't have all the different illustrations without the triggers in there. Look how low the surrender charge is. Low surrender charges. Very low. I could drop those off, but it costs me a fee, which hurts my cash value growth. So those are very low surrender charges. And I'm gonna show you that's probably the cost. There we go. Fine. Bam. Oops. Sorry. Now, I don't like it, but that's the way it is. Premium expense charge, cost of insurance, policy fees, expenses, total of $1,100 the first year. Okay, so that's the credit interest, 6.22, but don't worry about that. If you take this number here, subtract it for that number, you get the total amount of planned premium that makes it into the cash value column before let's do that. So let's say 12,000 minus, let's see, let me find my calculator here. Let's see. Let's see, calculator. Calculator. Where's my damn calculator? All right, so let's see, 1,000 minus 12,000 minus what was that number? It's like 1,000. What is it? 1,000. $1,058. $1,058. $1,058. There we go. So 12,000 minus $1,058 equals 10,942. 10,942. 10,942. So 10,942 divided by 12,000. Oops, 10, 10. There you go, 91%. So, 12,000 minus the cost, and fees of, he said, of the policy divided by, it gets you to 10,942, and then divide it to 12,000, 91%. So 91% of your plan premium gets into the cashback column. And then they give you a credit interest of $364, which brings your cash value accumulation to $1,100, $308. But even before the credit interest is credited, you get 91% of the cashback column. Let's see, still recording? Wow, yes, still recording. All right. So, let's see. Is there anything else I can show you? Let's see. Let's see, age. Let's see, age 80. Age 80. See, age 80, cost of insurance, see how low it is? It used to be super high before I pulled all those triggers. Cost of insurance. Age. It falls off of age 86. See how low the cost of insurance is? Damn. Now they do charge you the LIBOR. LIBOR cost is expensive, and I understand that, but I'm in the LIBOR, which is guaranteed, so I'm not going to lose my policy because of my guaranteed income payments. But I wanted you to see that the cost of insurance is very cheap, when in other designs it gets very expensive in the cost of insurance column as you get older. These are LIBOR costs. That's the cost of having that LIBOR. So you could say it transferred the cost of insurance over to the LIBOR, but again, at age 65, which is up here, bam, age 65, you can see the there's no LIBOR, bam, the column kicks in, LIBOR payment.